Hello everyone, welcome back. This is a three-part video series of wealth creation by investing in ELSS/mutual funds. Here we'll take an interesting analogy of cricket to understand slightly advanced concepts of mutual fund investing. So this is not an explainer video about basic concepts like what is ELSS, what are large cap, small cap funds and so on. So in this series, we'll explore concepts like why index funds are most preferred for long-term investments and how you can use technical analysis to maximize your returns from index investing. Also, we will compare the benefits of SIP and lump sum investment and understand when to do what based on market conditions. Finally, we'll speak the language of numbers like absolute returns, profit, CAGR, inflation and tax deductions, and we'll understand what these numbers tell to us and how much we need to start saving to reach our money goals in the next 10, 15 or 30 years from now. Let's begin with the first part. We'll shortlist two ELSS funds for short term and long term, but you can do the same analysis to invest in any equity mutual fund. I can hear you saying about Quant mutual fund. Okay, we'll discuss why investing in this fund is not a good option right now and why there is a 50-50 equal possibility of this fund to underperform in the coming years with proof. Okay, let's get started. There are two things to decide before investing in mutual fund. The purpose of investment. Is it for short term or long term? Short term goals include buying phone, laptop, car, or investing for an international trip or saving for your marriage expenses. Target is ideally to build a corpus of 20 lakh in 3 or 5 years. Long-term goals include wealth creation for retirement planning or saving to buy your dream property after 10 or 15 years. Second, your risk profile. It is not the same when you are in your 20s or 30s and after you enter your 50s. At an younger age, you can prefer to take more risk in the stock market to maximize your returns, but for long-term wealth creation, safer options like index investing are often preferred by investors. We have a beautiful story to explain this concept at the end of this video. There are three categories of ELSS funds. First, the aggressive funds. Funds which have only 50% allocation to large cap and have significant allocation to small and mid caps. They are very volatile due to this nature and are highly risky but generate higher returns. Usually they have high expense ratio because the fund manager is rotating the capital aggressively to make short-term gains. Here we can see the last 1 year returns of SBI, Bank of India, Quant and ESP ELSS funds. They are all above 40 or 50% and even 60%. These funds in the context of cricket are like Maxwell, Pollard and Russell. Sometimes they outperform like anything, like hitting 100 in 30 or 40 balls or 50 in 15 or 20 balls, but sometimes they do not score any runs. Let's check their last 10-year performance. Here, strike rate is similar to your 1 year returns. In a good season, their strike rate is very high, but in a dull season, they have poor performance and the pattern is not consistent. You can see some of the years where the strike rate is 187 for Glenn Maxwell, followed by 129 next year. Russell has some impressive performance of 184 and 200, but it is followed by 144 in the upcoming year. And we can see the strike rates are all over the places like 200, 100. It is not very consistent overall. Likewise, the small cap funds outperform the Sensex in a bull market and underperform in a bear market. This explains their volatile nature. Consider the year 2003 where the Sensex has generated 90% returns, but the small cap index has outperformed by more than 100% and delivered 200% returns. But during the time of 2008, that is during the Lehman Brothers collapse, Sensex has fallen by 52%, but small cap has aggressively fallen by 72%. Second category, the most renowned funds. They predominantly invest in large cap companies and have very less exposure to small and mid caps. They too have high expense ratio because they are actively managed. These are some of the funds like Canara, HDFC, Axis, ICICI ELSS funds. We can see that they have 70 to 85% allocation in large cap, whereas the small cap allocation is around 1 or 2% up to 10%. These funds do a fairly good job in failing to beat the benchmark index. Here is a snippet to explain the same. The chart represents the percentage of funds that outperform their respective benchmarks in 1, 3 or 5 year period. We can see the category of ELSS funds where in a 5-year period, only 22% of the ELSS funds have outperformed their benchmark. Ideally, investing in large cap funds can be easily done with little bit of research. It is straightforward. You don't need to give your money to a fund manager to invest in companies like HDFC, ICICI, Bajaj Finance, HUL, Nestle, Titan, Lawson and Tubro, Asian Paints, etc. Let's understand this better. Correlate funds with IPL team and stocks with players. Large cap funds are like RCB, Punjab Kings and Delhi Capitals. They are not consistent with their performance and have never won IPL title so far. We can see the 9-year performance of these three teams where we can see they always end up in either 6th or 8th position all the time. But what about their players' performance? They are very impressive. Let's view the performance of Shikhar Dhawan, KL Rahul and Virat Kohli. They all played for Delhi, Punjab and Bangalore respectively. For a 9-year period again, when we check the average runs scored by Shikhar Dhawan, KL Rahul and Virat Kohli, we have numbers which are always higher than 35 and around 40 for all these three players. And when we check their strike rate, it is not unlike the previous example of Glenn Maxwell, where it is either 180 or 100, 200 or 90, but here it is always around 120 to 140 for the entire duration. These players are similar to Nifty 50 stocks. They are consistent performers. They are the best of the best players. So it is not because RCB has bad players or large cap funds invest in bad stocks. The mix of players in their team is not working out well for them. The third category, the all-rounder fund. These are index-based ELSS funds. Yes, you heard me right. They mirror the index and are widely recognized as secure tools for long-term wealth creation. Here we have only 3 funds so far in this category. Navi Nifty 50, 361 ELSS Nifty 50 and Zerodha Large Mid Cap 250 ELSS, which is recently released in 2023 October, which invests mainly in 3 indices, Nifty 50, Nifty Next 50 and Midcap 150. They have the least expense ratio because they are not actively managed and are passively replicating the index. These funds are similar to CSK and MI teams. Both have highest playoff qualification and have won 5 IPL seasons so far. We have the past 14-year data here. Even in the seasons they didn't win the title, they are still in the top 3 positions. Again, it is not because of individual player performance but the entire team itself. And it is evident that the best team is the index itself when it comes to large cap funds. Likewise, it is evident from the graph in a 5-year period. Only 11% of the large cap funds have beaten their respective benchmark, which is the Nifty 50. For long-term investing, consider dividing your investments in these 2 funds. 60 or 75% allocation to large mid-cap 250 and the remaining 25 to 40% in Nifty 50. A lower percentage to Nifty 50 because it is already a part of large mid-cap 250 fund. Now let's shortlist the funds for short term. Remember, we talked about funds with large exposure to small and mid caps. I'll show you 3 more funds that satisfy this condition but are not best performers in this category. Let's check Tata, Motilal and PGIM ELSS fund. If you check their 3-year rolling returns, they are well above 17%. But we will aim for funds with 25 or 30% CAGR in a 3-year period. Now, what is rolling returns? We'll discuss it shortly. These funds change their allocation in small and mid caps every quarter without deviating from their underlying theme of generating higher returns. Restrict to 2 or 3 funds for short-term investing and don't invest in a new ELSS fund every year. Diversification is always good and it reduces concentration risk, but it's important to avoid over-diversification. Also, managing too many funds can become very challenging. We will discuss 3 key parameters to compare and select the best funds in this category. First parameter, recent annual returns. Ideally, you should not be looking at the past year performance to decide if a fund is good or bad. Here is a simple explanation. Let's take 2 funds A and B. During a market crash, fund A falls by 15%, where fund B falls aggressively by 25%, and from the bottom, fund A manages to increase by 53%, whereas fund B outperforms and increases by 67%. But when we check the entire 1-year duration, fund A has outperformed fund B by generating 5% more returns. So a better way is to check the trailing returns or CAGR. It measures the average annual returns between 2 dates of an investment, assuming the returns were compounded annually. Funds with higher CAGR can generate more returns, but they fail to capture the volatility of the fund. Here we can see in a graph where CAGR and volatility is plotted. Also, we have one more problem. Let's say a fund's past 3 years CAGR is 30%. What is the probability that it will deliver the same returns if you start investing in it from today onwards? For this, we need to check the rolling returns. This is an advanced concept, but we will understand this using the cricket analogy. Analyzing rolling returns is the most effective method for evaluating mutual fund performance. As the name suggests, it calculates the CAGR returns for a certain period on a continuous basis. Consider the runs scored by Virat Kohli and Rohit Sharma in each IPL for the past 14 seasons. This is like similar to analyzing 1-year rolling returns for the past 14 years, and the total runs here correspond to 1-year returns. Virat scored more than 300 in almost all matches, where Rohit managed to score more than 300 for 85% of the time. It gets more interesting when we analyze the chances of scoring more than 500 runs, where Virat has a massive record of 43%, whereas Rohit has a lesser chance of scoring more than 500 runs, which is around 7%. So by checking the consistency of the past performance, an investor is able to take informed decision of investing in a mutual fund or not. Let's take an example to analyze 3-year rolling returns of some funds. But why 3? Because it is short term. You can also do it for 5 years. Here we have 3-year rolling returns from May 2018 all the way up to Jan 2024 for a period of 3 years. These are top 3 performers that generate consistent CAGR of about 20% for more than 75% chance in a 3-year window of investing during May 2018 to Jan 2024. But when we check the Quant ELSS fund, it has impressive performance to generate more than 20% CAGR returns for 99% of the time during this period. Alright, as we conclude, I like to highlight 3 key parameters from our discussion. A strong strategy is to book profits in short-term funds and rotate the capital to long-term ELSS funds without bringing in new capital. Let's say your ELSS fund after 3 years has given 80 to 100% returns. You can choose to withdraw 1 lakh capital from this, which incurs no tax, and reinvest it for long-term. Second, high expense ratio are not always bad when selecting a ELSS fund. If your holding period is less than 5 years and your fund is expected to generate more returns, then it is very fine. But for long term, choose a fund with low expense ratio. Third, the idea is to grow our wealth slow and steady over long term, but also enjoy some high returns in a short period when there is opportunity in the market. But why can't you invest in a riskier asset for long term and generate more wealth? Here is a short story to explain the same. There are 2 individuals, Ramu and Somu. They both enter into a challenge of generating more returns at the end of 20 years by investing in mutual funds. But Ramu invests in Nifty 50 index fund, which usually compounds at around 12% CAGR. But Somu invests in a small cap index fund, which usually compounds at a rate of 20 or 25%. And he aims to generate more wealth than Ramu. They both agreed to follow the same investment style and agreed to deploy the same capital over 20 years. For some months, both will do SIP or both will do lump sum, but the entire principal amount remains the same. 10 years down the line, Somu's corpus has already reached 5 crore, but Ramu's fund has generated only 1 crore. So at this point of time, Somu is clearly willing, but in the next month, something bad happens. A disaster strikes and the world witnesses a pandemic situation, and the stock market is crashing down like no tomorrow. It appears like a doomsday situation. After a month of chaos, Somu's portfolio lost 80% of the value and it is down to 1 crore. But Ramu's portfolio, which is more stable, has fallen by only 35% and it is down to 75 lakh. But Somu loses faith in the stock market and sells his entire stake because he could not take the volatility of seeing his fund going from 5 lakh to 1 lakh in a short period. But Ramu held on tight during these tough times. Unlike any other fall, the market bounced back after an year of consolidation and touched new highs. So the best way to make money in stock market is investing for long term in less volatile assets. benefits. Let's conclude with our proof about Quant ELSS mutual funds. Here is a chart showing the 10-year rolling returns for a 14-year period starting from June 2010 all the way up to Jan 2024. For Quant ELSS fund, there is a 45% chance of getting 20 plus CAGR returns, but it also means that it has equal possibility, that is almost 55% of generating lower than 20%. Whereas the other funds like Axis, DSP and Bandhan ELSS have more than 70% chance of getting 15 plus CAGR returns. Which is better? It is for you to decide. Okay, having decided the ELSS funds to decide for both short term and long term, the next question is how should I invest in these funds, and should I do SIP or lump sum, and when to do what? How to build a long term corpus of 10 crore? What about taxation in mutual funds? And what is the actual worth of 10 crore after 20 or 30 years from now? Let's talk about this in the part 2 of the series. Stay tuned until then.